the yield curve inverts, we are either in a recession or not far from a recession. And we would say we've been in a rolling recession for the past year, year and a half. The yield curve inverted for the first time in July of 2022. So it has been more than a year. And we think that it is a harbinger of much slower economic growth and lower inflation than most people believe.
Markets rejoiced on Wednesday when the U.S. Treasury announced plans to increase government bond sales in Q4 2023 by less than investors expected. This triggered a 20 basis points decline in U.S. 10-year yields, its largest daily drop since the recent bond tantrum began in the summer. Dovish FOMC hints alongside a disappointing ISM manufacturing report compounded the move. This is a welcome development, especially given the share of longer-dated marketable issuance vis-a-vis T-bills has fallen over the last 3 quarters. The yield on the benchmark 10 years U.S. Treasury note touched 5% for the first time in 16 years last week, spurring debate about whether it has peaked or just taken another step in its long and disruptive climb. With interest rates at multi-year highs, this risks depressing economic activity and weighing on household consumption, especially as excess savings are declining. Ultimately, any government will find itself needing to restore its sovereign credibility rapidly by reducing spending to compress risk premia, right when public welfare programs must expand. Cathie Wood now gives a more detailed outlook on fiscal policy and what it means for the economy. She also shares her views on monetary policy and other economic indicators. As you watch, make sure to hit the like button, subscribe, and drop your comments below.
The government may shut down in mid-November. We do have a new speaker in the House, but there is still partisan saber rattling, or they may get a continuing resolution, so we don't have to deal with this over the holidays and move the debate into January. It's just becoming de rigueur now, and I think investors are getting used to it. They don't like it. Nobody likes it, but it is what it is. The other thing that happened actually this week was an executive order on artificial intelligence, which we think can be described as serious overreach and certainly favors the incumbents and we think would really hurt innovation. So it is an executive order. We do think that both Bitcoin or crypto or digital assets and artificial intelligence now could become part of the election year debate. The federal deficit as a percent of nominal GDP since the late 60s. And I remember in moving into the business or coming into the business in the late 70s, early 80s, during the Reagan administration, when the deficit hit 5%, there was hell to pay. I mean, both sides of the aisle were up in arms. Now, it happened because of back-to-back recessions, you can see in the shaded lines there. And as Federal Reserve Chairman Paul Volcker was slamming the brakes on money growth. And so we had a difficult period, and typically the deficit does go up during difficult periods, recessions in particular, because of what we call contracyclical spending. This is what government is supposed to do, provide a safety net. Well, you can see what's happened since then. We're now supposedly without a recession. We're at roughly 6% as a percent of GDP, the deficit is. And so the question is, oh my goodness, what would happen in a recession? Well, you saw what happened in COVID. During COVID, that's where contracyclical spending really kicked in. And so we're back roughly to where the deficit was pre-COVID. Now, as many of you may know, we believe we've been in a rolling recession for the last few years, and we'll get into that with more charts. So maybe this spending and this deficit is more contracyclical than many people think. And we learned from the early 80s that the best way to get out of a deficit like this is to have very rapid growth. So you'll look at the 80s and 90s. We had spectacular growth. Technology was coming of age. Inflation and interest rates were coming down. And you can see what happened to the deficit. It turned into a surplus during Bill Clinton's administration. And we think that could happen again. So we are not as negative about the deficit, although we do believe that the spending programs that have been put in place in the last couple of years after the initial COVID spending have been overdone. And as I've mentioned in prior in the nose, government spending is taxation of one form or another. It will turn into taxation, whether actual taxes to try and cure it, or in the case of a rapidly growing economy, the taxes that go with that would be a good solution, or inflation. And many people look at what's going on now and say, this is a recipe for inflation. The way to get out of debt is to inflate it away. We don't think that's going to be the case. And we'll get into a few indicators in a moment that support our view that actually the risk is not inflation moving forward. It is deflation.
While monetary policy is in the driver's seat in the battle against inflation, fiscal policy can help restore price stability and lessen the impact of the cost of living crisis on the poor. When considering new measures or reforms against the backdrop of significant inflation, policymakers should consider that different groups of households may already be experiencing sizable distributive effects. Smart fiscal policy, involving tough policy choices on what budget items to cut and which to protect or expand, can support monetary policy in the effort to bring inflation down while protecting those most affected by the cost of living crisis. Let's now get back to the video as Cathie Wood shares her view on monetary policies.
Chairman Powell this week during his comments after the board meeting, I think he had an inkling that the employment reports this week were going to be weak. I think he probably had a sense of initial claims. They went up. But also perhaps an early read on the employment report, which today was very weak. And one of the reasons it is so weak is this chart. So this is money growth, M2 growth on a year-over-year basis, going back into the 60s, early 60s. And you can see we've never seen a decline in money like this in this period of time. You have to go back to the 1930s, which of course was the Great Depression, to see a decline in money like this. Now, this is the other side of what happened during COVID. So it's it's understandable to some extent. But now we're soon going to be lapping 1 full year of negative money. And so the course correction has taken place, we believe. If money doesn't pick up, then what we will conclude is it's becoming a serious drag on the economy. And deposits are leaving the system. The regional banks still are losing deposits. That's part of the decline in money. And that's not a good thing. In fact, the KRE Regional Bank Index is revisiting its March lows when we were in a crisis around the regional banks. So the regional bank index is a warning that Fed policy has just overdone it here. We hope it doesn't break down the index. And it is possible that some of the numbers coming out now are making the case for a Fed pivot so clear that the regional banks will not face as stiff a competition from money market funds and will be able to attract deposits again. So this is M2, still declining year over year. And here is the yield curve. Now, we've talked about the yield curve here many times. Here's the picture going back into the 70s. This is the 10-year Treasury yield minus the 2-year Treasury yield. And when it's below zero, it means that short-term interest rates are higher than long-term interest rates, which is not normal, as you can see from this chart. And you can also see that typically when the yield curve inverts, we are either in a recession or not far from a recession. And we would say we've been in a rolling recession for the past year, year and a half. The yield curve inverted for the first time in July of 2022. So it has been more than a year. And we think that it is a harbinger of much slower economic growth and lower inflation than most people believe. The other point we like to make about this chart is, to see a yield curve going down to -1 or -1% or 100 basis points, just like it did in the early 80s today, is quite something because the base of rates is so much lower. So today we have the long bond yield in the 4.5% to 5% range. Back in the 80s, that number was 15%. And yet we have had the same degree of inversion here. That tells us that monetary policy today is much more stringent than it was even in the early 80s when interest rates were at 15%. Because 100 basis points on 4.5% to 5% is a lot more dramatic than 100 basis points or 1% on 15% interest rates. So we think monetary policy is much tighter than many understand.
The cancellation of 2 large offshore wind projects in New Jersey is the latest in a series of setbacks for the nascent U.S. offshore wind industry, jeopardizing the Biden administration's goals of powering 10 million homes from towering ocean-based turbines by 2030 and establishing a carbon-free electric grid 5 years later. The Danish wind energy developer Ørsted said this week it's scrapping its Ocean Wind 1 and 2 projects off southern New Jersey due to problems with supply chains, higher interest rates, and a failure to obtain the amount of tax credits the company wanted. Together, the projects were supposed to deliver over 2.2 gigawatts of power. The news comes after developers in New England canceled power contracts for 3 projects that would have provided another 3.2 gigawatts of wind power to Massachusetts and Connecticut. They said their projects were no longer financially feasible. In total, the cancellations equate to nearly 1/5 of President Joe Biden's goal of 30 gigawatts of offshore wind power by 2030. Despite the setbacks, offshore wind continues to move forward, the White House said, citing recent investments by New York State and approval by the Interior Department of the nation's largest planned offshore wind farm in Virginia. Interior's Bureau of Ocean Energy Management also announced new offshore wind lease areas in the Gulf of Mexico. While macroeconomic headwinds are creating challenges for some projects, momentum remains on the side of an expanding U.S. offshore wind industry, creating good-paying union jobs in manufacturing, shipbuilding, and construction, while strengthening the power grid and providing new clean energy resources for American families and businesses, the White House said in a statement Thursday. Industry experts now say that while the U.S. likely won't hit 30 gigawatts by 2030, a significant amount of offshore wind power is still attainable by then, roughly 20 to 22 gigawatts or more. That's far more than the nation has today, with just 2 small demonstration projects that provide a small fraction of a single gigawatt of power. Large ocean-based wind farms are the linchpin of government plans to shift to renewable energy, particularly in populous East Coast states with limited land for wind turbines or solar arrays. 8 East Coast states have offshore wind mandates set by legislation or executive actions that commit them to adding a combined capacity of more than 45 gigawatts, according to Clearview Energy Partners, a Washington-based research firm. What do you think about the macro outlook by Cathie Wood? Do you think the problem is deflation? Let us know your thoughts in the comment section below. Also, don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.